Hey everyone, welcome back to Corporate Decoder. Today, ARAI Incorporated ticker ARAI just filed a notice of delisting, and I am seeing one red flag that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. ARAI is in hot water with Nasdaq for not meeting the minimum stock price requirement, and the clock is ticking. On the 2nd of June of 2026, ARAI Incorporated received a letter from the Nasdaq stock market. This letter flagged a serious issue. The company's stock price has been below $1 for 30 consecutive business days. This is a big deal because Nasdaq has a rule called the minimum bid price requirement that companies must follow to stay listed on their exchange. If a stock consistently trades below $1, it can be a sign of trouble for the company and its investors. Now, the good news is, this notice does not mean ARAI's stock is being delisted immediately. The company is being given a grace period, a chance to fix the problem. They have 180 days from the date of the notice, which means until the 30th of November 2026, to get their stock price back up to $1 or more for at least 10 straight business days. This situation reminds me a bit of what happened with Sears back in the day. They faced multiple delisting warnings and constantly had to find ways to boost their stock price, often through stock splits or other measures, but ultimately it did not prevent their eventual bankruptcy for ARAI. If they do not meet the $1 minimum by the 30th of November, they might get another 180-day extension, but they would have to meet all other Nasdaq listing rules like market value of publicly held shares. If the company fails to meet the requirements even with an extension, Nasdaq will then issue a final notice that the stock will be delisted. ARAI would then have the right to appeal this decision to a Nasdaq hearings panel, but that is a difficult path to win. Looking at the company's basic information, their common stock trades under the ticker symbol RE on the Nasdaq Global Market. Keep in mind that ARAI is also classified as an emerging growth company, which means it can take advantage of certain regulatory relaxations, but it also signals that it is still relatively new and potentially more volatile. The filing is signed by Daniel S. O'Toole, the Chief Executive Officer, on the 5th of June 2026, indicating the company is aware of the situation and is formally reporting it. Let's talk about the implications of this. A stock trading below $1 for an extended period is often seen as a bad omen. It can make it difficult for institutional investors to buy or sell the stock, and it can signal a lack of confidence from the market. For ARAI, this is a critical moment. They need to demonstrate to Nasdaq and to investors that they have a viable plan to turn things around. The company says they will actively monitor the stock price and evaluate options, but honestly, there is no guarantee they will succeed. If they do get delisted from Nasdaq, the stock would likely move to over-the-counter markets, which typically have less liquidity and lower valuations. Now, external context, ARAI is in the technology sector, specifically dealing with scientific and technical instruments. Their market cap is around $25 million, and they have about 43 employees. Recent headlines show they were at an aerospace summit, which could be a positive sign for future development. However, they also received a warning from Nasdaq about this sub $1 bid price. Back in April, there was some positive news about ARAI announcing their fourth quarter and full year 2025 results, highlighting progress towards scaling their autonomous delivery network. This suggests they are actively working on their business, but it is not translating into stock price stability. Institutional holders like Geode Capital Management and BlackRock are holding small percentages, indicating limited large-scale investor confidence at this stage. What is my take on all this? The core issue here is trust. Nasdaq's warning is a direct signal that the market is not valuing the company's stock favorably. While the company has a compliance period, the history of companies facing similar situations is not always rosy. Many companies that get close to delisting due to low stock prices often struggle to recover. For instance, when Kodak went through a reverse split in 2021, holders of their stock saw about a 40% additional drawdown in the following 90 days. A hypothetical $1,000 investment there could have shrunk to around $600. This indicates that even after a stock price boost attempt, the underlying issues often persist. ARAI needs to show concrete progress in its business operations and a clear path to sustainable profitability to convince both Nasdaq and investors. The risk I am watching is whether they can achieve this within the short time frame they have been given. My biggest concern is that the business fundamentals might not be strong enough to support a sustained stock price recovery. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take, stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.